Director of Blockchain Labs. And I'm going to spend some time today talking about blockchain. And this is an introductory sort of session where we'll discuss some of the technology imperatives, some of the history, some of the foundations, and discern between a lot of rhetoric that's out there in terms of what blockchain is. So we will talk about what a distributed ledger is, how is that differentiated between what we in the industry term as blockchain, and what are we trying to achieve that, not just in the permissioned world and the permissionless world, but also in terms of how enterprise is consuming those two elements. So with that, I think we should probably get started. And the way I have structured this presentation, I've broken this down into three different elements. I've talked about what is blockchain, where we will spend some time in understanding the constructs, the foundation, the fundamentals. And we'll then try to apply what we have learned to various business use cases. And these are real-world industry use cases that me and my team at IBM have worked with globally with different clients. Why is it relevant for our business? What is business trying to achieve with it? And because I have an IBM perspective, because we have been engaged in various client projects, I will assert in terms of what we have done to assist and help our clients in achieving their objectives and understanding and getting arms around not just technology, but also the business elements of getting started with kicking off a network. So with start, I do want to go back to basics. Some of these constructs that are introductory, we end up using a lot of these in terms of what is a business network, the wealth, the markets. These have a grave implication in terms of what we're trying to achieve in blockchain network as we design these various networks that involves various business entities. And if you look at it, we have networks today. I mean, we do have various business networks because a business never operates in isolation. There are various participants in the business network that includes clients, suppliers, purveyors, banks, partners. And in most cases, business networks that exist today will connect these various participants, right? So in many cases, we begin to see that, these business networks, as we are either trying to transform and disrupt, every conversation in blockchain networks do begin and end with business networks. So it's really important to understand not just the construct of the industry type, but also inside of the industry, there may be various industry subgroups that represent the business network, which defines the asset types that we're dealing with. And then look into wealth. And the reason why we talk about wealth is because blockchain is about things of value, and we are trying to determine a network that we are creating that facilitates the movements of things of value. So if you look at wealth, which is typically generated as goods and services move across the network, this flow of exchange of goods and services is referred to as markets. And that comes to a third construct, where markets to us, whether it's public or private, is central to this whole process. That if we are trying to move things of value, then there's a buyer, there's a seller, and there are various intermediaries who are involved, whether they're providing a trust service or registry service, who are involved in moving that things of value from point A to point B. So the growth of wealth can be constrained if the network is either siloed, inefficient, ineffective, or grossly inefficient in terms of the way it's processing transactions. And I think that's the competitive advantage that many geographies, that many countries, that many banks and many financial institutions are trying to get their arms around, is how do we have the handle on that efficiency that gives them a leg up in terms of what they're trying to achieve from a blockchain perspective. And we oftentimes draw an analogy or simile between what Internet has done for information, which essentially is it has made the access to Internet, which has become ubiquitous, has provided various business opportunities because information is no longer confined to a certain few. It's accessible to everybody as long as they have access to the connectivity point. And we are trying to achieve something similar from a blockchain perspective, where we are trying to achieve what Internet has achieved for information, is try to achieve some of the similar economies of scale for things of value, which means that we should be able to transfer things of value as easily and as ubiquitously with built-in trust from point A to point B across the globe without going through the massive system that may induce inefficiencies or cost to the system. So we do talk about transferring assets and building value and unlocking the potential of capital that simply is constrained because of the existing systems, either because of inefficiency or because of access to the market by certain few elements. So if you look at transferring of assets, there are various asset types. There are fundamentally, we do discuss the notion of tangible assets, things like house, things like cars, things like gold, silver, diamonds. And then you have intangible assets, and this distinction between the two elements is important as we look into tokenizing of these assets, is that you have assets that are intangible in nature, that are essentially things like mortgages or mortgage-backed securities or securitization of physical assets. And that's important because in most cases in blockchain world, our goal is to digitize these assets, and eventually we will talk about how do we ensure the tokenization of these assets from the physical world to the digital world, and why is that relationship really important to ensure the integrity of the asset. And then we do further classify the intangible assets, whether we're talking about financial services, and this all goes back to looking into the notion of what we call as asset types or asset classes, where in financial world you have assets like bonds, securities, mortgage-backed securities, equities, and intellectual capital. You may have patents, or you may have copyrights, digital rights management, like we see in music and entertainment industries. And then eventually the last mile problem, which is to me one of the most important facets of what we're trying to solve with blockchain, is cash, is ability for me to be able to move money as simply as transferring cash without the nuances of cash management, without the nuances of the nefarious activities that results because of cash, and that also leads to inducing, the real-time settlement that we talk about in the financial market world. So these constructs, I think, for us as blockchain professionals, is really important and vital to understand before we go into much more complex topics. Only because I think, as we apply technology, and as you will see as we discuss use cases, is that in many cases that these control points are really important to understand of how things are done in existing markets, and as we relate them to what's to come in future markets. Now, I'm going to spend some more time looking into some of the technical constructs, things like ledger and transactions and contracts, because we talk a lot about some of these elements in blockchain design, blockchain networks, technical conversation. And so in most cases, if you look at ledgers are not new. I mean, if you look at what we have done back in the day when ledgers were from a traditional bookkeeping perspective, they've been used for double entry bookkeeping, single entry bookkeeping since 14th century. And then eventually we went into double entry bookkeeping later on. So ledgers are not new. They're essentially what we term a system of record of a business, which means if you're recording, you deposit money, it's recorded in the ledger, which determines what's the balance of your account. You buy a property, there's a ledger at the county level or at the property registry management level, which defines the ownership. And if the property has a lien, then you understand that is registered too, which defines the true sense of the fractal ownership or the relationship between you and the financial institution that pertains to that asset. So ledgers are nothing but a system of record. Businesses may have multiple ledgers for multiple business types, and this is where we begin to talk about multiple asset types. We talk about multiple businesses, multiple rules that govern the movement of assets. And this is pertinent to blockchain because at the end of the day, it is a distributed ledger technology where we do want to ensure that there's a trust built into the system to prevent things like collusion, to prevent things like, certain parties controlling the outcome, to ensure that the network itself is, the movement of asset is defined, is trusted, and the transaction is maintained. That brings to transactions. And if you look at transactions in traditional technology terms, it's not a gray area. Transactions typically means that assets transfer, there's a finality to it. If I sell you my car, the transaction is complete, then you get the car keys and I get my money. And actually, in financial terms, that transaction is complete when all the requisites of the transactions for that asset class are met, whether it's bonds, securities again, or mortgages, or you're buying a house. All these asset types have their own transactional element that allows them to ensure finality of the transaction. And then we have contracts, which essentially governs or is a glue between the conditions that we ensure that when you buy a house and a car, or when you sell your securities or your stocks, there are certain contracts that you have to maintain, and these contracts, it's essentially, to me, is the glue which ensures that certain rules are adhered to as we move an asset from point A to point B. The example that I cite here is that if Anthony pays John money, the car passes from John to Anthony. Fairly simple. But I could have a mechanism in which, in this day and age, I can have a lock on the car, electronic lock, which says that if the funds don't reach John, then the car would not start. And this becomes a bit more complex because I'm adding additional conditions to that entire system, which means that while the car has been transferred, the transaction itself is not final. And we begin to review these constructs, the ledger transaction contracts, as we design the blockchain systems. So this is our sort of the foundational elements of our system design imperatives, as we will see as we discuss further from a blockchain perspective. Now, what we are heading towards from introducing blockchain, if you look at why we're doing blockchain, because the business exists. We do have businesses, we do have business networks. So what are we trying to achieve with blockchain? I think it's important to understand that fundamentally, blockchain is trying to solve the issue of time and trust. And these two constructs have enormous implications in many industries. Time, because when time it takes to transfer money, whether it's cross-border payments or money from bank A to bank B, if it takes a few days, then the economic potential of the capital, the money that's locked in the system, is not realized because the money is between multiple parties as it goes from one ledger entry system, which is from bank A to bank B, or from multiple entities who are involved, especially in the case of cross-border payments or cross-border movement of assets. And trust is because you have the birth of many entities who are involved in ensuring that the trust is maintained, and there's a fee and there's a cost associated with the trust model, because either these entities are licensed or they are a part of the system, the existing network, by virtue of the system itself, to create this neutral third-party entities, which is oftentimes required between two parties to ensure that there's trust in the system. And this role of third party, like a clearinghouse, is to make sure that not just the rules, but also certain regulations are adhered to. So time and trust are two fundamental constructs, and depending on any use case, I use this as my litmus test. So while each of these entities may have their own shared business processes, we are trying to collapse those business processes into a distributed, trusted shared ledger to not just collapse the systemic business processes, but also ensure that the efficiency of that flattened business process to the network, from the network to the enterprise, that translation is maintained, and that translation translates to essentially efficiencies, cost efficiencies, process efficiencies, and elements around some of the models that we're trying to create with blockchain. Moving on to the problem that we're solving, and this is something which I discussed earlier, that this is a before picture. Like, for example, this represents status quo of existing business network, which essentially is inefficient, expensive, and vulnerable, where I have multiple parties, multiple participants with a point-to-point relationship, point-to-point connectivity, which leads to each participant keeping their own ledgers, which is updated to represent business transactions as they occur. And because they each maintain their own ledgers, they have to ensure that that transfer of ledger happens to other entity. And this is enormously expensive because of duplication of effort, that each of the entities will have to maintain their own technology systems, they have to maintain their own staff, they have to maintain their own systems to ensure there's no fraud, there's no loss, there's no economic loss to the element because of whether it's time or delay or trust factors that are involved. So it's clearly inefficient as the business conditions, the contracts, because it's duplicated by every network participant. Every network participant maintains ledgers, and we believe that those are some of the fundamental elements that we're trying to solve with blockchain. And it is also vulnerable because if a central system, which in this case, for example, a bank, is compromised, which we have seen a lot lately, due to an incident that affects the whole business network, the incidents can include fraud, cyber attacks, simple mistakes, and we've seen a lot of that stuff where We've seen cross-border payments, movement of money, only because a single bank system was compromised, and that compromise or that sort of vulnerability led to taking advantage of the sort of attaching the bank to the network and taking advantage of moving those funds where they don't belong, or erroneously or fraudulently moving those funds. So this is the problem that we have today. And if you were to take this to the next level, we are trying to solve the problem by flattening that entire shared business process to a single infrastructure with a shared replicated permissioned ledger. And I'm going to spend some time on this permission versus permissionless in a minute. But the idea here is that with blockchain architecture or blockchain-inspired technology design, we essentially want to ensure that all the participants in the network have the ability to share the common ledger that's updated every time a transaction occurs through peer-to-peer replication, which implies that no matter which party aspires to transact with each other, that they can, as long as the network has visibility and this is a broad concept. We can go into consensus, and we can eventually talk about how do we discern between the privacy confidentiality, because in real world, I don't think any bank or any financial institution or any business would want to share their information with other participants. And those are technical sort of elements. But in principle, the idea is that as these transactions move across multiple participants, multiple parties, these entities eventually are able to rely upon the network to ensure that the transaction between two parties is adhered. Cryptography is used to ensure that the network participants see only the part of the ledger. This is where the privacy and confidentiality come into play, that are relevant to them, and that the transactions are secure, authenticated, and verifiable. And to ensure the security, the authentication infrastructure, and the verifiability of the network, we are now introducing various elements like identity and blockchain, and ensuring that the entities who are participating in this permission network are permissioned, which means that they have given permission by the network or by affiliates of the network to be able to participate in the network, which means they're identified entities, as opposed to what we have seen in some of the permissionless networks like Bitcoin and Ethereum, where anybody can join the network, and that has its own advantages as well as the downfall in terms of the cost of computing to ensure the transaction finality. In this case, we are also looking into ensuring that the blockchain also allows the contract or asset transfer to be embedded in the transaction database. What that means is we oftentimes use the word smart contract, which, as I explained earlier, is a glue that governs the rules and ensures that the transaction finality is maintained. That there are smart contracts that run on these blockchain networks. There are processes that run to ensure that the network itself has agreed upon certain terms and conditions, again, based on asset types, based on industries, based on subclasses of those industries. And there's a regulatory element to this as well to ensure that smart contracts are liable, where as I'm moving the asset or as the asset moves to the system, these smart contracts have visibility. Smart contracts are involved in the handshake, finality, movement of assets, and so on and so forth, and determining the conditions under which the transaction can occur. So the various technical elements like consensus, provenance, immutability, finality, these are, to me, the pillars that provide a platform for blockchain to provide the value that we are trying to describe and to achieve the promise of blockchain in making efficient, faster, secure, trusted networks. So these, to me, consensus, provenance, immutability, finality, should be a part of every blockchain professional's vocabulary, because these provide the foundational pillars on which blockchain sort of sits on. And based on these pillars, the various network participants agree upon, and that's the agreement element, is the consensus piece, as to how transactions are verified through consensus or similar mechanisms. There are certain elements of governance, the oversight, the compliance, the audit. Some of these elements are as integral part of these networks as we begin to see. So various participants, same as before, this is not a disintermediation play. We are looking at ensuring that the same participants who are providing the value to the network can still be part of the network, except that we are first step of most blockchain networks is to digitize the existing processes, is to be able to ensure that we have a notion of a digital asset, and the players can still provide the same value as long as they are playing by the rules. And consensus essentially gives you the notion of providing the means as all participants agree, or a fraction of participants agree, for the transaction to be valid. Provenance, the second pillar that I talked about, it means participants know where the asset comes from and how its ownership has changed over time. Then we talk about immutability, which to me extends or lends itself to the trust system. It means that no participant can tamper with the past record, which we've seen historically in bookkeeping realm, in areas where books have been manufactured, and there has been certain elements of ledger entries that have been manufactured. But the immutability preserves that notion that if we are sharing the data in the network, or sharing the transactional data in the network, then nobody has the ability to go back and change the data, and it's immutable record in general, which means that if a transaction occurred in error, then you would have to induce a new transaction at the design principle to reverse the error, as opposed to what we do today, where we have a rollback mechanism or a mechanism that induces that part. And when we talk about finality, we do mean that there is one place, there is a single notion of transactions to be determined that determines the ownership of an asset or completion of a transaction, which means there is no gray area. We have to make sure the transaction is final, and once the transaction is final, the network accepts the transaction, and we move on with the next step, which is the next piece of transactions. So those are the fundamental tenets, pillars, as we talked about from a blockchain perspective. I think it's important for every blockchain professionals to have this in their vocabulary and understand the intrinsic elements of how we map this to other constructs, the other business constructs that we discussed earlier around wealth and markets and ledger systems. Now, I'd be remiss if I don't talk about Bitcoin, because Bitcoin, the genesis of blockchain conversations, the potential, the promise as we see it, as we envision it, comes from Bitcoin world. And so in many cases, this is where I would like to sort of assert the discerning between the permissionless world and permission world, where Bitcoin essentially represents this notion of permissionless world, and hence the costs and expenses and the time it takes to process a transaction to achieve transaction finality, and all the things that you may have heard about the energy it takes, is because permissionless network essentially is open. These are networks that doesn't need anybody's permission. As long as you have the right connection points, you can join the network, and as long as you're willing to expend the compute power, the time, the resources like electricity and energy, power, security elements, then you'll be rewarded with the product of the network itself, which is a byproduct of consensus mechanism, which is proof of work, with a Bitcoin, which essentially is the currency in the system that's required, again, to be used in the system to process transactions. So in many cases, I think what we are seeing is the divide between the permissionless world of what we are seeing with networks, very valid and technically astute networks like Bitcoin and Ethereum, to what we are seeing in the enterprise world, where we see that we have a much higher need for transaction processing, we have a higher need for security, we have a higher need for some of the elements around this, where if we permission entities, then the computational overhead needed for security and to ensure the cryptography is right. I think in many cases, permission network is able to address those elements to say, if you know all the known parties, then we don't have to go through that cumbersome process of defining the computation or dedicating the compute power. To ensure the trust in the system, we can ensure the trust by virtue of choosing the right consensus mechanism and ensuring there's checks and balances in the place of the system to prevent collusion or to prevent fraud. So I think that's the foundational element that I would want the audiences to understand as to why it's not one or the other. I think there's two parallel streams of permission and permissionless world, and some of us in the industry do believe that in future there's a convergence point once the technology is more mature, the industries are more comfortable using it, there's enough regulation that catches up with the innovation. I think once some of these elements begin to fall in place, we begin to see convergence of these two sort of constructs as we move forward with blockchain evolution. Now, I would like to now focus on a few things that there are many blockchain frameworks, there's technology elements, there are technology networks, there are blockchain networks that exist today, but foundationally or fundamentally, any blockchain network in the world has these four elements underneath the covers. And these goes back to a few elements that I discussed earlier in terms of contracts, in terms of consensus, in terms of immutability, finality. As I described earlier, those were the pillars. But if you look at some of the requirements of blockchain for business, you have to understand that most blockchain networks in the world essentially are distilled down to these four elements. So first one is, of course, shared ledger. Second is smart contracts, privacy, and trust. And I'm going to spend some more time in going through some of the details. But essentially, the blockchain technology, whether it's Hyperledger, whether it's Ethereum, whether it's Quorum, whether it's Bitcoin, they all have these four main building blocks that leads to increased efficiencies, cost reduction across the network, as we talk about. And it's up to us to tweak these things and pick the right technology that's required. And this is where we begin to talk about system design, is choosing the right consensus, choosing the right authentication mechanism, verification mechanism, cryptography, figuring out the right consensus model, figuring out the right database behind the shared ledger, and so on and so forth. So where we will begin to unpack some of these broad conversations that we're having here in coming slides. But the idea there is that, we have to distill this down to what are we trying to achieve with this, and these four, to me, represents the four basic sort of building blocks of any technology platform. And as you encounter many technology platforms, to me, I use this model to map to see which shared database you're using, what's the consensus mechanism, what's the privacy mechanism, and when it all fits in, it helps us digest, articulate, and provide a taxonomy to various sort of technical frameworks that are available today, which can be a cumbersome task. So what we have done at IBM, and I'm going to spend just a few minutes on this topic, is we've taken that model and said that most, as a technology provider, we're interested in ensuring that you have tools to develop applications, which means it resolves the elements of embarking on existing skill sets. We want to ensure there's enough governance, whether it's speed of activation, onboarding entities. We want to ease that process because that process can take time besides just the technical elements. There are contractual elements. And once the network is up and running and as it grows, we want to provide enough tools for entities to be able to operate the network, to be able to do a few elements around ensuring the SLAs, the network operational sides of the house, also an interface between the technology elements of managing a network and mapping that to some of the elements that we see in terms of business side or the business impact. So I think these three, what we have done is broken down our technology offerings, and what any enterprise should consider is development, governance, and operation. And I think these three will generally act as a guiding principle as we design networks and as we consider blockchain network for permission world, to ensure that there are participants and there are blockchain operators, and which ensures the health of the network, because the network has to be up, it has to be robust, it has to be fast enough, it has to be secure, because the growth of the network will then dictate the viability of the network, as well as the advantage of the various participants who are involved from a network perspective. Moving on to some of the examples, and I'm just going to spend a few minutes that me and my team have been involved in many of these projects that you see in the slides, and this should give you a fair representation of the diversity of the various entities, starting from financial services to KYC, to food safety, supply chain, provenance, energy, loyalty, risk compliance, post-trade settlements, and so on and so forth. So this, to me, goes back to what I was discussing earlier, the notion of time and trust. And those two constructs have enormous implications for industry in terms of inefficiencies, in terms of cost, in terms of cost of fraud, cost of locked capital. So there's an opportunity cost element, there's an efficiency cost element, and there is a new opportunity or new business models that we envision, whether it's liquidity provisioning or what we have begun to see now with stable coins, and what we have begun to see now with new models that may emerge with instance economy around some of these elements. So some of these, I view them as leaders that taken the first step. They have expended time, energy, and talent in investigating as to what is this technology element of it, but at the same time, they have looked into focusing on the new business elements that we can derive from not just application of technology, but the changes blockchain can induce in these business networks. So now let's quickly go through some of the imperatives that we talked about. Shared ledger. Essentially, ledger is the first thing that constitutes blockchain. We start with ledger. It's an append-only system of record that is appropriately, ensures privacy and confidentiality and permissioning elements of it. It's shared between participants, but that doesn't necessarily mean the data is open. They may be, as a design principle, we can induce opacity of information using cryptography, using certain elements of hashing power, or simply ensuring that only two participants who are involved in the transaction get to see the transactions. In some cases, participants may have their own copy through replication. We can choose a model where every participant have a copy, but not every participant have access to readability of the copy of the data. And because it's permissioned, I think the liability of entities who own the copy of the data is higher, that we can have certain audit requirements that ensures that if an entity is involved in opening of data or manipulating data, then audit tools are able to catch that, and certain, whether it's a legal action or certain action from the network operator perspective, can be taken, which incentivizes many players to essentially behave well and adhere to some of the governance models and principles laid out by the network operators. So at the end of the day, it is modernization of ledger concepts that's been around for ages, and essentially this is the system of record. The next building block is smart contracts, and to me, smart contracts are very generically used in the industry, and I have a very specific need for it. And I view smart contracts as a glue between the rules of engagement and governance of moving an asset. It's verifiable, it's signed, it's agreed upon by various participants. It is the second thing associated with blockchain, as we discussed earlier, after shared ledger. For technical audiences on this call, a transaction is analogous to a stored procedure, essentially. So you can view a smart contract as a stored procedure, but essentially this is a smart contract that is a code. It's a trusted code that runs the network that ensures certain rules are adhered to before the asset is moved and is responsible for transaction finality. If you look at privacy, which is again one of the building blocks, not every member of the network should be able to see all the data. Cryptography is there to control who can see what. And so the idea there is to be able to leverage certain elements or certain spectrum of cryptography that we have employed to ensure that we are using the right design methods as required by the business network requirements to ensure that transactions are authenticated. As we introduce smart contracts, they go through a certain governance process. So privacy becomes a core sort of hallmark of a lot of design elements that we consider from blockchain perspective. And the last framework that we want to talk about is the trust, which to me, at the end of the day, blockchain is an element that builds the trust network. So a ledger is a trusted source of information, which means that because it's derived from final transactions that's committed to a ledger and network agrees upon it, we do rely on various consensus mechanisms, and there are various gates that leads the trust system. So the notion of consensus, the notion of immutability lends itself to the trust system. There's a notion of verifiable audit trail, and all these elements define the trust system of the network, which leads to the point that this is a very important design consideration for blockchain professionals, for us to be able to ensure that we're using the right technology as required by that network and the asset type and the business participants of the network, to ensure that we're not just using the cryptography in the sense to induce privacy, but we're also using the right consensus mechanism to achieve the right transaction throughput, to achieve the right model, at the same time ensuring privacy and confidentiality. I think that's the balance that, in my opinion, I had to make in terms of ensuring we're using the right technology set, making the right technology decisions to be able to not only fulfill that requirement, but at the same time ensuring that so trust to me is a central point of whatever we're doing in blockchain world. So having discussed broad level principles, pillars that provide blockchain a platform to grow and to ensure that trust is maintained, some of the basic tenets, some of the business elements, I want to now take what we have learned in understanding the blockchain, not just the technology elements, but also the constructs of blockchain, to why is it relevant for business? Why are we doing it? We already have a world and we are able to move things of value. We have banks, we have financial institutions, we have mortgage companies, we have the world that we live in. So why is it relevant for the businesses? And eventually we'll go into some of the use cases of that well. So foundationally, if you look at some of the benefits of blockchain, and this may seem like a marketing slide, but I think each of these points have an implication where if you improve, for example, we talk about saving time, removing costs, reducing risk, increasing trust. All these have, again, a foundational element of either disruption or transformation to the business network, or disruption or transformation to the existing business network. So if you look at some of the benefits, in addition to saving time, again, time and trust. So if we are saving time, that means that we're able to move money faster, money moves faster, or assets move faster, and you unlock the potential of capital as we know it. If network become efficient, the cost points of network operations or transaction processing goes down. That leads to advantage to the network, that leads to lower cost of transaction, that leads to higher economic activity. As we all know, fraud and fraudulent activity, vulnerabilities due to technology elements cost a lot to the industry, to many industries. So if you were to reduce collusion, fraud, tampering of the system, I think the industry and the consumers, I think, benefit equitably, where there's no economic loss at the same time. There are parties that can be held accountable. And eventually, increased trust leads to shared processes, shared record keeping, and some of the entities that are defined around that model. Other benefits, of course, include improved discoverability, automated trust processing, ensuring that there's a trusted record keeping. So some of these benefits are, I think, vital for us to understand. I think if I were starting this all over again for many of the novices or many of the intermediate elements, I would keep them as some of my design principles as I'm focusing on devising a technical design for blockchain. Now, I want to give some examples of what we have seen with some of the clients, and these examples lead to essentially use cases. So there's something called shared reference data, and we do begin to talk about the fact around shared KYC process, for instance, that any reference data that is shared in a business network is potential blockchain network. That's a ultimate use case. We've seen that in media entertainment. We've seen that in shared KYC, in financial services. We've seen that in insurance. So many industries who are looking at shared reference data across geographies, across various companies, I think blockchain becomes the right technology to be able to facilitate that and reduce costs and transform the networks. Some examples, think bank routing codes or common vocabularies for asset data exchanges. We've seen that in chemical industries where there's a whole slew of shared data around, whether it's the safety data or whether it's airline industry, there is provenance that needs to be maintained. So those becomes ripe use cases for blockchain networks. Supply chain, again, time and trust. We've seen that with what we have done with food trust at Walmart is tracking the provenance of meat. For example, what we have done in our own use case in IBM Global Finance is reducing the cost of trade disputes or of disputes with suppliers, for example. What Everledger has done with storing the provenance of diamonds on blockchain to prevent trade in so-called blood diamonds, for instance. So the idea here is to ensure that supply chain, which is laden with many, many intermediaries and many, many business processes and paper-driven processes, leads to enormous amount of fraud, enormous amount of inefficiencies and time it takes to move goods, not to mention the economic cost in the event of perishables, economic cost in the event of small and mid enterprises who are involved and who are dependent upon the speed so they can realize the cost and value and progress their business. So the idea there is the trust increases, we improvise on overall utilization of the system, and eventually the notion of recalls and tracking and tracing leads to an enormous amount of efficiency that we have seen in the system. We look into audit and compliance. I think in blockchain, eventually, especially in financial cases and most regulatory or regulated industries like healthcare, financial services, insurance, we begin to see that the cost of audit and compliance and regulation drastically goes down, either because of shared cost of audit and compliance, shared cost of movement of assets, but at the same time, because it's a shared network model, we begin to see lower cost of audit and compliance. We begin to see that seek and find capabilities for the auditors, that auditors themselves can be part of the network, thereby reducing the cost for all the participants to provide reporting that they have to do on a regular basis, and eventually changing the nature of compliance itself from more passive to more active and more sort of proactive and predictive, applying predictive analytics to understand the history of transactions and how these transactions are linked. So audit compliance make a perfect sort of use case, and then we begin to look into letter of credit, where we begin to see, the LOC, a letter of credit as an asset, as an example in trade finance. The asset can only be done from bank A to bank B, which alleviates the use of the letter of credit with more than once, and the fraud that's associated with, and also every bank that has an army of entities involved in verification costs of letter of credit. I think that all that cost can be significantly reduced with blockchain by introducing letter of credit as a digital asset. So likewise, I've laid out at least 4 broad categories. What we have seen, and this is just a small sample, what me and my team have worked drastically is around these use cases around financial industries, public sector, retail, insurance, manufacturing, government. We see a whole slew of use cases with enormous potential, which can exploit blockchain technology to either improvise, transform, or even disrupt some of the elements around blockchain technology. What we have seen now is we begin to see where we are now in the second phase of compliance ledger was the early days. We begin to see consortiums forming. We've seen that with insurance industries. We've seen it with trade finance all over the globe. We've seen that in shipping industries. Now we see the food safety industries. And we begin to see that as the industry matures and as we go into tokenizing assets, and I've written extensively about this topic, that blockchain use cases tend to fall into some of these 4 categories as we broadly define it. But what we see with the lower level categories around compliance ledger and consortiums tend to be easier only because we are trying to address the systemic element and induce efficiencies. But things become really, really interesting when we begin to start tokenizing assets and moving assets across not just multiple parties or in a network efficiently and with speed, but also across geographies where I can now create instances of that asset and open up new markets, new potentials. And eventually, this will catch on with high-value markets like private equity, for example, where transfer of high-value financial assets can go between multiple participants and be adhering to regulatory timeframes as we know it. So these are some of the patterns that we have observed. I think as you're reviewing the use case that you are working with, understand some of the regulatory challenges, requirements from technology to appease that requirement, but at the same time adhere to the technical governance element as well as the regulatory governance element of that use case. Something that you should understand that most blockchain is about network, which means that one single client cannot accept and use blockchain to improve performance. You need to have multiple players, multiple participants, and you'll find that a regulator, or industry group, a market maker essentially are some of the key players in most blockchain networks. I think we've got to start looking at this from a point of view of who are the players who become part of the participants, what is the asset, how do we move the asset, how do we devise smart contracts to glue some of those elements. These are some of the considerations that I think should be considered from that point of view. And to sum it all up, what we have done, and this is what IBM has done, what we have done for our clients is around technology, is you need to have a few things. You need to have technology, of course, which, as I discussed earlier, development tooling, infrastructure, having the right mindset, having above all the right support, because in most cases you need high availability of these networks because they have direct business impact. And then you have hosting and support, which whether it's on-prem, cloud, hybrid, or instituting a Dockerized container that allows you to, so whatever your mechanism is, whatever poison you end up, choosing, you have to ensure that you have the right model, because oftentimes you may have a quasi-centralized or quasi-decentralized models where a network operator may host some nodes, but some business may choose to host their own nodes in a private infrastructure. But the network should be coherent in terms of quality of service, in terms of technology stack, in terms of maintenance. And eventually the idea there is design, and design, where I think I have always professed this, is that more time you spend in design of these networks, especially in permission case, I think the growth of the network and achieving efficiencies, whether it's technology-led or business-led, can become more meaningful. With that, I do want to take a minute to thank the organizers and the audiences for taking the time to listen. I'm hoping these, this time was worth your time, as well as you achieved something from this session. And I think from now we can open up for questions, and I'm happy to answer any questions.